Going on YouTube? What's up, EJ Tribe? Welcome back to another live stream here with the Everyday Growth Advisors. I hope you are having a good morning, evening, wherever you are, and happy Chinese New Year to all of the Asian people that are tuning in. I hope you have a prosperous and successful year ahead in 2023 as we move into this chaos of a market that we are dealing with. Not much on the macro side to update you guys from, except for a little bit of projections for FOMC. But we also will be going through some of the earnings expectations for the next couple of weeks, as you all know. And if you have received my newsletter, you would know that there's quite a few catalysts that are on the way for the next couple of weeks that are going to cause a lot of volatility. Just coming this week and the next week, we have an abundance of earnings that are going to be reported by majority of the companies on the S&P 500, and also heading into next week we have FOMC that will be happening from FOMC will be meeting from 31st to 1st and likely to deliver their rate decision as well. So that's all going to tie in. We also have later in that month CPI once again, and so yes, there's a lot of things to pay attention to as we head into this next couple of weeks. Now, I want to talk about a little bit about the market backdrop and what the market is expecting versus what the actual situation is. As you know, earnings season kicked off, 2 weeks ago. And so far, it's been about 55% of, just a couple of companies that have reported earnings have pretty much reported earnings below expectations. And that's, if anything, should be a telling sign. Remember that financials also didn't report very strong earnings, heading into this first quarter of the year. Obviously, they're reporting earnings for Q4 2022, But just heading into this year, we are not looking at very good performances from majority of companies in the S&P 500. Now, the market backdrop is that inflation is cooled down and the Fed is likely to remain less restrictive of interest rates, and we're likely to get, that normalization of rates at a much earlier pace than what the market is expecting. The bond market, on the other hand, is saying, no, we don't really think so. We think that, earnings recession is still a thing, and, we are calling out the bluff, based on what the bond market is kind of sniffing out here, right? But obviously, what people think gets priced into the market, and then what has been priced in the market comes up with another expectation. So it's kind of like a mutation of an existing genome, or like think about a COVID variant. It's a similar expectation. It's like, the market comes up with this conclusion, it morphs into something else, and then it becomes something else, and then people start speculating on that new thing, and then it becomes something else again, and so on and so forth. Let's see. Your voice cuts out for 1 second every 20 seconds. So I was doing it last week too. Not a huge deal. Is my voice the voice not proper on the stream? Let me see. Audio. It should be fine. Okay, cool. Could be on your end. Okay, it's all good. Anyways, I was mentioning, the expectation of the market right now is very, it's very whipsawy. Now, the reason for this is really simple. The market comes up with an expectation and then morphs it. And so far, in this past, couple of weeks, we've seen a lot of expectation of the market on this run up here, saying, oh, hey, we think inflation's over, especially since CPI came out. Remember, this is when CPI came out, right? And the market started to buy up those expectations. And then just last week, we had, that kind of move to the upside, and then a huge rug pull based on the Fed chair, commentary, I would say. And then exactly 2 days later, the market reversed again on another bout of commentary from another Fed chairman. So the market's really unsure on what it wants or what it aims to decide for. But there are a couple of things that are unavoidable. Okay, now earnings compression is going to be a real thing. It's just when it's going to happen. Is it going to happen this quarter or next quarter, right? Because there tends to be a lag about these things. Not to mention that as more and more companies start to lay off employees, that's also going to seep into the efficiency of the economy. The other thing is, the longer rates stay higher, that also increases it increases consumer price parity for some groups of people, but also decreases consumer price parity for some groups of people. So in this case, it will eventually lead to margin compressions. Okay, margin is the key word here, because as sales start to drop and expenses start to remain high, more and more companies are going to be affected by the prices that have been the prices that have been increased through inflation, right? And that's eventually going to lead to the top and bottom line of their balance sheets and income statements being squeezed on either side. Okay, and this is one of the reasons why the byproduct of this is companies who have over forecasted their employee situation in the past 2 years after the COVID kind of situation happened, right? Everybody was like, oh, hey, the economy's back. And then they started spending a lot of money on hiring people. And now they're starting to realize, oh, man, we didn't really need that many people. So they're starting to cut away and trim away the fat. And this is something that we're seeing. It's a thematic thing that we're seeing across the entire market, not just tech companies. And this is eventually, a combination of higher prices, a higher instability within price parity, which we are going to see translate into earnings. The question is, when does it happen? Does it happen this quarter, which is Q4 earnings, or are we going to look at it as an effect in Q1 2023 earnings, which means next quarter we'll see those results, right? But whatever it is, the market is a bit too optimistic right now, in my opinion. Okay. In fact, the FOMC rates projection. So just to touch on that a little bit, besides the earnings expectations, it seems that the market is pricing in a possibility of pretty much a 4.6% terminal rate in the Feb first meeting. And then in the next meetings after that, also it's pricing in a similar one, except for we're looking at, in fact, closer to June, where we're pricing in a little higher terminal rate at 4.9. So that would assume that from here to here, there would be some kind of a 25 basis point rate hike. And I think the market is also assuming that there might be another 25 basis point rate hike anytime between now and June. And that also could be the Fed could decide to, say that, oh, hey, we're in a restrictive stance right now. We don't need to increase interest rates. And then CPI falters to go further lower. And then we get a higher CPI number at some point. And then they kind of do another 25 basis point rate hike, maybe somewhere closer in June, right? Or May. It could be around this timing, right? So market expectations right now are a little whipsawy, as I was saying. It's not really pricing in much. But the inline expectation across the whole market is that in 2024 or 2023 end, that's when the easing of interest rates starts to come in. As early as Q3, but I don't think that's possible. I think there's only a much higher chance in Q1 of 2024 that this is likely to happen. So in terms of FOMC projections, this is what the market is pricing in now. And remember, if any data comes out to suggest otherwise, then all of these things are going to shift once again. So I'll continually update you guys as to what the market expectations are of this scenario. And it does just look like right now the market is a bit too ahead of itself in terms of optimism. Okay, this is my personal opinion, guys, and obviously I could be wrong. Okay, and I'm not going to be right all the time, trust me. Okay, so let's jump into the technicals. Now, I mean, obviously now that we've covered the fundamentals here, let's jump into some of the technicals. We had nice bounce on the dual zone from last week at 3,900 roughly, right, which is in line with our newsletter outcome. And we got a nice bounce up into 3,971. This level right here, as it coincides with this downtrend line, could once again act as a resistance. Not necessarily always, but it could. If we do break that, then we are aiming for a fake out up into 4,000. If you read the newsletter, I have already projected that this week we are likely to go up to retest 4,000 and then reject here. Or if we break 4,000, then 4,060 becomes on the table, and then that becomes the next resistance. Okay. So these 2 points this week will be really important, and if we fail to break out, then we're likely to reverse back down into 3,900 first, and then ultimately 3,800. And that's what I'm looking at for this week in terms of volatility, in terms of the price targets of the S&P 500. Now, we have a very volatile week ahead. Remember that this week, a lot of companies are going to be reporting earnings. Who are reporting earnings this week? I'm glad you asked. Well, we have... Just today, we'll have Logitech. We'll have a bunch of banks that are reporting after. Then tomorrow, before the open, we have Johnson & Johnson. We have Lockheed Martin. We have General Electric, Raytheon, 3M. A bunch of industrials are reporting this week, right? We have Microsoft reporting tomorrow after the close. We have Texas Instruments, Capital One. We have ADP on Wednesday, which will give us some insight on job processing as well. Lam Research, AT&T, Boeing, Tesla, all on Wednesday. Then you have MasterCard, you have Visa, Intel, Southwest, Nokia, and let's see, a bunch of airlines as well. And then Friday you have American Express, you have, let's see here, Chevron, no other notable names there. So you have quite a few people reporting earnings this week. And obviously this is something that you should be aware of. Heading into this week, because there's going to be quite a bit of market volatility, especially after Microsoft reports earnings and Tesla reports earnings. The market might kind of move in a certain direction based on what their earnings were, and then they might start to price in earnings of other stocks. Then the speculation begins, and then you guys know the process from there. They start speculating whether Google's going to beat, whether Apple's going to beat, and so on and so forth. So the right strategy to play these would be, well, for today at least, is to play some, earning run-ups. There's a possibility that we could play that. And that's what we've been seeing a lot in the past, 2 weeks, 1 to 2 weeks. We've been seeing these dips and then rallies. mainly positioning for earning run-up plays, and then they might just kind of either break out from here, try to go retest 245 on Microsoft, and then ultimately, if you get further upside, then the sell-off. So apart from that, we want to be aware of obviously the major points of the market which are going to see considerable reversals or considerable rejections. One of them is IWM that I have been watching pretty closely, right? And IWM is your Russell 2000 ETF, small cap, mid cap, right? And this has been a sector or a rotation that I've been looking at for a while. They've been, pushing really hard on this side of these companies, and a lot of this buy-up has been companies that are super oversold, and really pretty much growth stocks that are small caps. So they've been pushing a lot of this up, and obviously if there's no real fundamentals behind these stocks, then it's just going to fall right back down. So I'm looking for a rejection on IWM this week at around 186, or even if it gets back up to 188, then I might want to take a downside trade on this one with a nice risk-reward ratio setup. This could be a nice bearish trade, or if it does indeed break out of 188, 189, then that gives me the bullish setup for the upside. So either way, I want to play this, take either the bullish or the bearish trade based on what I see, and that will be the setup that I'll play. So we've already explained SPX, we've gone through IWM. Let's also talk about NASDAQ a little bit. And NASDAQ obviously is going to be the one where everybody's going to be putting their eyes on. But remember that the one that people are going to be putting their eyes on is going to be the one that's going to be manipulated the most. So NASDAQ, with almost looking like it wants a double top here, but it's obviously uncharted at this point whether it's actually going to be that. We want to be cautious at this 11,670 level. If we break out of this, then obviously, retest of 11,700, and then all of these upper levels here at 11,800, 11,900, 12,000 even comes in to this upside. If we reject here, then obviously we're going to come back down to 12,200-ish to retest this lows here, which we have done twice. And so then this could become a chop zone for a little bit on NASDAQ until things get sorted out by FOMC. So a lot of chopping back and forth with NASDAQ right now with, we hope would be another directional week. If not, it's going to be a painful week, okay? So that's all I have for you guys in terms of updates. If you have any charts that you want me to do for you right now, go ahead, post it in the comments, and I'll take a look at them. Semiconductors have been on a pretty nice rally so far. I'll be looking to play any pressure on this to the upside if I can get momentum on NASDAQ and the breakout. If not, then I'll want to play the rejection back to the downside on semis. That's the plan for this, specifically for me. So I'll be looking at semis as a whole here through SMH and probably playing it as a proxy instead of betting on individual names. Not to mention dollar index was selling pretty aggressively pre-market and then started buying up. There's also energy, which has been taking off as per our call out on this weeks ago. I told you guys about energy when it started bouncing here on this live stream. I spoke about it again when it bounced here again. We've been playing this to the upside a lot lately. And then we've been taking a breakout play to the upside after that. On this bounce right here also, we didn't add to the position, but I had a running position as it came back down the bounce. So the energy position is still open and well, and it is doing good. No, I have not done Tesla yet, so I can do Tesla for you. So we took a bullish swing on Tesla on Friday. Hopefully it holds here within the next 15 minutes, but likely to take some profits on that one. We took some $135 calls for this week expiry last week on Friday, as you can see. So these should be paying pretty nicely at the open. They are in the money now. And I have two targets for Tesla. The first one has just been hit. The second one's going to be at 139. So what I'm likely to do is take profits on majority of the contracts that I have on these, and then either roll some of the profits into a higher strike with a longer expiry, or just take the profits off and let runners do their job because its earnings are this week. If you want, you can take all the profits on all the positions except for one contract and hold that contract through earnings if you wanted, if you're feeling bullish about Tesla. They have been having some pretty good earnings and earnings momentum if you look at it. So with Tesla, I think that this risk to reward ratio setup so far has been favoring the upside, and it's been in an uptrend after this huge decimation of a sell-off. I think it's very normal to pull back 50%. So let's have a look at where that 50% level would be based on this huge downward wave. You would want to see where the 50% pullback is going to be. So that 50% pullback is actually at 150, which means that Tesla has still a decent amount of upside on this pullback. But remember that the pullback doesn't need to get there immediately in the way that you think it's going to get there. Remember that there might be chops along the way. There might be pullbacks like this where it breaks trend and then ultimately gets there. So nothing goes up in a straight line. So far, it's been very zigzag. It's been very nice. It could have a couple more pullbacks before it gets to 150. But the time horizon is going to be pretty wild because it'll be at least a month's horizon. And right now we are approaching maybe about 2-3 weeks more till it gets there. So maybe 2 weeks. Yeah, we're looking at about 2 weeks time before Tesla gets to 150 or the retracement level of the 150 level here at the upside. So that's what I'll be looking at on Tesla personally. And yeah. Now, what else? NVIDIA. Okay, let's have a look. So NVIDIA is on our snipe list this week. Really simple plan with this one for this week. What I want is either a pullback to 170. What was it? Hold on. Let me just have a look at the snipe list real quick. We have it as our plan this week. Yeah. So 172. We want to pull back to 172-ish if we really want to take the bullish bounce. Other than that, I don't want to play the upside here. So this setup here, I know a lot of retail traders will be looking at this and going like, yum yum, like I want this upside, right? But look at that risk to reward ratio setup, right? If you take that risk on here, let's have a look at that setup, right? Let's say you take it at the break right here, 179. You're gonna take on pretty much all the way down to this level here because this would negate your trend, right? And then you're gonna take this upside here, right? All the way up to this resistance, let's just say, right? Probably up to here, right? What does that give you? That gives you a 1:1 risk to reward ratio. That's a terrible trade, right? That's a terrible trade. So what I do want instead is, this pullback to 172-ish area, right? And then I can take a possible bounce trade to the upside if it has pulled back. And that upside trade is likely going to assume that this is going to break out, right? And it's going to give me that, upward ascension to either 195 or even 192 around this level, right? Around here. This dramatically improves my risk to reward ratio. And it's a better setup. That's the bullish trade idea for this week. The bearish trade idea, that means you're preparing for both sides, is going to be that you take that run up, you let the run up happen to 188, this area here, 188 all the way to 190, and then you wait for the rejection. You play the rejection to the downside instead. And obviously that's going to be a much superior trade in terms of risk to reward ratio because your short entry is going to be, let's say in this region here, you'll have all of this to capitalize on. And the risk that you're really taking on is pretty much like that much, right? So you'd have pretty much this is your resistance up here, which would be your stop out from your short trade. All of this over here is going to be your stop levels, which you're not going to get out of. Only above like 196, 197. I would even go up to 198 would be the stop out level. And your profits would be all the way down here back into the 168 range. And obviously this is going to be a swing trade. So that's the way I would look at NVIDIA right now. Of course, let's also have a look at the volume profile to see if it matches up. And indeed, it does, right? So you can see that a lot of this buying has been happening at the 172, 170, 168 level. This is the major volume shelf right here. This is where price action will likely to come back down to after it starts to go up here and starts to test these upward limits back here. So in terms of just pure price action, that's what I'll be looking at on NVIDIA. I hope that was helpful. D. Patel. Eddie, I hope that was helpful on Tesla as well. And that's all I have for you guys today. If there's no more questions, I'm gonna get off the stream right now and get onto the live trading session with the team. I wish you guys a great day and happy trading session. We are about 8 days away from the launch of EGA version 3.0. If you don't know about that yet, go have a look at our Instagram. We just posted some information about that. It is a brand new course that we are releasing in the next 8 days. It's going to be amazing. For all those people who have been struggling with consistency, you have been lost, you know, you don't know what you are looking for, but you have been watching bits and pieces of things over the internet, or you've taken a course from elsewhere and it still hasn't really pieced together for you, that's the only course you're ever going to need. We're going to go through in-depth everything that you need to know, valuations and technical trading, as well as options, a deep dive into everything. And it's lifetime access. Plus you'll get to interact with me. So I hope that you guys are looking forward to that one. Super exciting stuff. And yeah, that's all I have for you guys today. Have a good one, guys. Peace out and take care. I'll see you guys back on Wednesday for another pre-market here. Bye-bye.